Welcome to Beneficial Conversations. We will explore the world of employee benefits and dive into the trends, challenges, and innovations shaping our industry. Join us as we sit down with industry leaders, HR professionals, policy experts, and thought leaders to discuss strategies for creating impactful benefit programs that support employees and drive organizational success. So whether you're an employee, a consultant, or you're simply curious, Beneficial Conversations looks to provide valuable insights, actionable advice, and inspiring stories to help you navigate the future of work. Welcome to Beneficial Conversations. I am your host, CJ Jordan. Today, I have the pleasure of being joined by Dan Bergan. He is a managing director within Higginbotham, focusing more on all things life insurance, some of the more basic things to, some of the more innovative ones. I think he has more letters after his name than he does in his name. But Dan, thanks for joining me, man.
Happy Friday, buddy. Appreciate you having me.
Yes. So before we even get into all the questions, I try to work this into every podcast I do. And you have not been prepped on this. I need to know the best meal that you've ever had. And this can be one that you've had at home, that you've made with family, friends, whatever. This can be, an experience that you had. Maybe you went to like Nobu and just had an incredible experience. But I need to know your best meal that you've ever had.
That's a good one. I'm not sure this is the best meal I've ever had in my life. It's the best meal I've had recently.
Okay.
Shout out to Chop Steakhouse here in Atlanta.
Okay.
They had a chimichurri steak paired with a port wine that was unbelievable. So
you can't go wrong with steak and wine, in my opinion.
No, and I'm a meat and potatoes type of guy anyway. So
no, I love it. I mean, you put a nice steak on the menu, you go to a nice place like that, you got to do it. And then when you compare it with a nice
let me
glass
flip
of
the
wine.
script. What is your favorite, CJ? I got to know now.
So let's see. Last time the script got flipped on me, I went with Ovenbird, which is here in Birmingham, which was a great experience. But one of the other ones that comes to mind is I lived in Memphis, for a long time growing up, and there's a restaurant there called Restaurant Iris, and the chef is Kelly English. He was a New Orleans guy, but came up. He lives in Memphis now, and Iris is, you're talking like intimate setting. I think they've got like less than 15 tables.
Nice.
And this was like, it was one of the best meals that I've had. You can come in and kind of say, hey, I want this 5-course option. And they just say, do you have any, aversions or anything? So they're not necessarily going to tell you everything that they're doing, but they're going to bring out kind of this nice, meal, each piece of it. And it was phenomenal. He's an incredible chef. It was with my family. I think it was maybe a birthday that I had, but just being around my family with that, and then the food was just top notch. So that's another one that just kind of ranks up there as, I can't even remember exactly what all it was, but I know that like each dish that came out just felt like it was better than the last. So that's one that sticks with me.
Sounds like a phenomenal experience.
It was good. So I want to hear a little bit about you. I want to hear about your background, kind of, how you came up, how you got to where you are. Kind of take me through, your coming of age into this.
Well, I joke and say life insurance found me. I didn't find life insurance. Actually came out of a semi-pro hockey career out in Canada and jumped right into the concept or idea of be your own boss, make your own schedule, unlimited income. Started my career over at Northwestern Mutual, wonderful training program there.
Yep.
Very quickly realized that life insurance has much broader applications than, just selling policies to your friends and family. And not that there was anything wrong with that at the time. Spent the next 20 years getting all these letters that you mentioned after my name. I can't even fit them here on the screen here, but that's the joke CJ and I had before this call was, if you know anybody that I can trade some letters out for a better golf stroke, I'll happily oblige.
I'll sign up for that too.
Exactly. So spent 20 years working through a variety of different major wirehouse institutions. Had the privilege of working at Merrill Lynch, had the privilege of working inside UBS, Wells Fargo. I was the head of insurance for a little company you guys may recognize called Goldman Sachs. It was at that point in time that I got, a really bird's nest view of how every life insurance guru skins the proverbial cat. And cats out of the bag. Some of them are really, really good. Some of them are really, really not so good.
Right.
But we like to think that we've kind of picked and choose different intellectual and proprietary capital over the years to put together what you know as the suite of resources here at Higginbotham.
Yeah. So is hockey still your one true love, or now that you're in Atlanta, have you kind of shifted to baseball and basketball, or is it still hockey at your core?
Well, don't tell any of my Atlanta Braves clients, but I'm still a diehard hockey player.
All right.
We do go see some games. My sons are both involved in soccer, although last night, a very timely question, was our first open skate together, whereby we are prepping for my 7-year-old son's learn to play hockey camp this
Let's
weekend,
go.
which means Daddy's going to have a large credit card bill heading into next week. It's a lot of fun ahead.
No, that's awesome. I love it. Well, when we talk life insurance, there's, a lot of layers to it. You know this better than I do. But, let's at least kind of start at the most basic of level, and we'll kind of build from there. Um, you know, Life insurance 101, I feel like starts at the term level. And, we were kind of joking earlier, about kind of the Dave Ramsey model, but I want you to just like, when it comes to the term life insurance for the people that are maybe early and young and just trying to figure out like, hey, what do I need? What do I do? Kind of let's start at the most basic fundamental level in terms of your thoughts on life insurance, just from like even the term mindset. Do you have kind of a rule of thumb that as you talk with people and, start to understand that you have a basic recommendation?
Oh yeah, we just guessed, CJ. You look like $5 million or so. You look like a $5 million type of guy.
Nailed it.
No, so there used to be some historic old rule of thumbs, right? Take 10 times your income and go
Right.
buy that amount of insurance. I think when you boil it down, term insurance is a necessity for anybody that has financial debts, obligations, or most importantly, families, people that financially rely and depend upon them. So term insurance is kind of unique. It's what we consider catastrophe insurance. It's something that if you fit the prior categories, I believe everybody should have.
Yep.
In the same breath, when you look at statistically the payouts around term insurance, less than 2% of the time do term insurance policies actually pay out. And as you get older, you will notice you have 10, 20, and 30-year term options. As you get closer to life expectancy, those options get reduced in age very strategically to leave you without coverage prior to life expectancy.
Sure.
Now, that's not to say, CJ, don't buy term insurance, because frankly, you never want to be one of those 2% of the people that have the catastrophe and are caught naked without coverage. But when it comes down to planning for this, most of my clients at its heart want life insurance to do one of three things. So it's kind of a morbid conversation, right? We
Yeah.
pretend we walk out of the door tomorrow and make a right when we should have made a left. We want to do typically one of the following. We want to make sure we clear any debt. So whether that's mortgages, credit cards, auto loans, etc., as we're going through this conversation, jot down those numbers. For those with kids, we want to do some college planning here. Are we going to in-state school, out-of-state school? Are we planning to go to Harvard? Where are we thinking here? Let's jot those numbers down. Have you done any 529 planning? Let's remove those numbers from the equation. That presents another kind of subset number.
Sure.
Usually those are fairly small. I mean, you got a $500,000 mortgage, you want to plan for Harvard, great. There's another $500,000, maybe more, but that's $1 million. And $1 million of term insurance, as most people know, is very, very cheap. For you and I, we're talking $30 a month, $40 a month, something very, very stupid. So, the last piece is the spousal replacement of income. And this is usually the largest number. And there's some nuances to this. So I'll make up an example. Let's say my household burn rate is $30,000 a month. And if I pass tomorrow and mortgage gets knocked out and kids' tuition is paid for, now let's say the family burn rate is closer to $10,000 a month.
Mm-hmm.
Well, should my wife not be working at that time or have a minimal income in relation to the household need, there would be a desire to supplement. And then the conversation becomes, how long are we supplementing for?
Right.
One of three conversations tends to take place. Hey, buy her a couple of years, and then she's got to figure it out and get back on her feet. That's usually a pretty tough conversation. The more frequent,
that one goes.
Yeah, exactly. The more frequent is, hey, God forbid that should happen. How much income would I need to get her to retirement?
Yeah.
thereby all of the other plans that are in place come to fruition. She doesn't necessarily have to go back to work because now she's got, double duty to take care of, so to speak, in this example. And we plan that out. The last piece of this is, plan for all the way to life expectancy.
Mm-hmm.
And this is, essentially roses and rainbows there moving forward. We just want to put enough coverage in place that, God forbid, something happens, she doesn't have to worry about absolutely anything, right? Doesn't have to go get married to another person to help support the kids, all the things that come with this. And oh, by the way, you can house these things in little things called life insurance trusts, whereby you can dictate the terms to the nth degree. So
Yeah.
typically, for a married couple family, when you look at combining that for an average household, you're talking usually a few $1 million worth of term insurance, typically somewhere between 3 and 5.
Mm-hmm.
I own 8 as a 40-year-old. I have some other investment properties and some other debts to cover, and some other things that I want to plan for. But I think I'm at a whopping $180 a month in order to protect that need.
Yeah.
Very, very simple planning, right? So that's kind of basics.
Right.
We like to think and compare and contrast that to permanent insurance in the following manner. Permanent insurance, obviously much more expensive, but as the name would indicate or imply, it lasts forever. And there's a whole bunch of different types of permanent insurance: whole life, VUL, IUL, guaranteed universal life, a whole combination thereof. But what I like to think of it is term insurance is renting coverage. We're
Okay.
renting it for 10, 20, 30 years. Permanent insurance is owning coverage, and very similar to those that own a home and have experienced mortgage pay down, whereby they're building equity. You can build an equity inside of your life insurance program. That can be beneficial for a variety of reasons. I think oftentimes in the life insurance industry, the permanent solutions get oversold, and the conversation tends to drift into, look at this as an investment option.
Right.
I have heard conversations and dialogues on the radio around, hey, stop investing in your 401k and start directing it towards these solutions. And let me tell you how wonderful these solutions are. So if it's helpful to viewers, CJ, I can walk through, in my opinion, what this is and what this isn't. I don't know if that's helpful. Yeah. Okay. So we'll
Yeah. I mean, no, I think it's great. I mean, I think the more that we can kind of explain and break things down, I mean, shoot, I'm interested just in this for my own.
Yeah. So a couple different ways to look at it. I think it's important to know from a taxation perspective, permanent policy feels and functions very similar to a Roth IRA. And it is very much not a Roth IRA. So let me make sure we say that. But it equates to the following. We're going to make contributions on a post-tax basis. Yep. Dollars are going to go into the life insurance policy. They grow tax deferred. And if we access this appropriately, i.e., taking our cost basis out and then taking policy loans out, we create a strategy whereby we can get access to gains inside of this contract on a tax-free basis. And for any of the insurance nerds in the world, it's IRC 7702 is the tax code that this falls under. But I say all that to say, look, if you have the option whereby, let's say, term insurance for a buy-sell agreement at a company would cost them $10,000 a year per partner. And at the end of a 10-year need, they're each out $100,000. Now, it served its purpose, and God forbid something happened, there was coverage there, right? So box checked. But what if instead of spending 10, you could spend 50? Now, this is a vastly different scenario from a cash flow perspective.
Right. Yep.
But it's also a vastly different end game scenario where now at the end of your 10-year time duration, instead of the policy expiring and you having to requalify or renew, you now have the exact amount that you contribute into the policy, in this example, $500,000 of tax-free cash. And you can do a few things with that. You can take tax-free distributions, i.e. income. You can leave it there, let it grow, and compound the death benefit higher, higher, and higher. Or for those that have literally checked the box, hey, they sold the company, this is no longer a need, good. Get all of your money back then. No tax consequences since you just met your $500,000 cost basis. Take the money and run, and you've spent nothing to have life insurance for 10 years.
Right.
This is where I think strategically life insurance from a permanent perspective has a really nice application for your average Joe, if you will. Now
Yeah.
that when you get into the estate planning world and corporate executive business structures and strategies, the vastly different type of a planning landscape and vastly different goals and solutions. But another thing that a lot of viewers have probably heard before is the term infinity banking. Be your own
Hmm.
banker, right? And there's some validity to this. Again, I think it's oftentimes positioned inappropriately. We have seen people that tell you, hey, CJ, put $1 million in this life insurance policy, and then you're going to take 95% of it out and put it back in your brokerage account. And then you're going to take that policy and it's going to have a participating loan structure whereby you're going to get crediting on the full amount. And what we know about those structures is you're robbing Peter to pay Paul. The only person who's making money there is the insurance agent. It does not work.
Yeah.
Said differently, permanent life insurance to be used appropriately is a mid to long term strategy. And to
Yeah.
define that further, you're talking decades, 10, 15, 20, 30 years out. For those that have ever read about John Rockefeller, you may have heard about the Rockefeller waterfall effect. Briefly, to describe that, it is using permanent life insurance to perpetuate legacy for intergenerational wealth. If anybody knows anything about Rockefeller, he studied money intensely.
Yep.
And what he found out, not just through his studies, but also in personal life, was that if Generation 1 was fortunate enough to amass a massive amount of wealth and they raised Generation 2 correctly, passed down stewardship, legacy values, all the good things, Generation 2 would be fortunate enough to keep that money around, but under almost every circumstances, Generation 3 was pissing the money away.
Yeah.
So the Rockefeller waterfall effect would say that, hey, if I was a Rockefeller, by the way, the Kennedys and a lot of other very wealthy families do this as well, and I inherited $1 million inside of a trust, I would be forced immediately to go out and purchase a permanent life insurance product for $100 million of coverage, whereby if I was a knucklehead and spent the whole $100 million that I inherited, that other $100 million went to the next generation and continued the legacy. This is not life insurance as an investment, whereby I'm comparing and contrasting this to real estate or stock market or anything like that. No, this is a separate bucket that has some very nice tax favored treatment that could provide some benefits if you also need life insurance.
Yeah.
That's how I think about this. Because if I'm a client and I'm in retirement and I have a nice bundle of cash in this permanent life insurance policy, and I also have my 401k and maybe if I'm lucky, a pension, now I get to sit down with my CPA every year and play some tax games. Here's what I mean by that. Let's say I need 200 grand a year to retire. Well, depending on where tax brackets are that year, I may be able to pull 150 from my taxable accounts, 50 from my life insurance policy, again, not taxable, not even reportable, and therefore compress my tax bracket from 25 to 20%. I'm just making up numbers here.
Sure.
I think that's where the rubber meets the road, because at the end of the day, look at what the insurance company's doing with your money. It's investing it in the other investment options. And I don't know about you, CJ, but life insurance companies and insurance companies in general tend to not do things out of the goodness of their heart, meaning they're going to pull up a profit in the process. So
that's correct. Yeah.
Let me pause there. That was a whole bunch of info, but that was more kind of personal side. And now we're delving into.
No, and I think even going back to the buy sell piece that you talked about, in the first scenario, you're talking okay, let's spend this money. And then, in a perfect world, nothing happens and those people are all okay. But then that money's just kind of gone in that term model that you were talking about. But when, you take a look at this other example and it's hey, let's invest a little bit more, but it's something that provides value beyond that 10 years. And so, I just think that that's a completely different way of thinking because, obviously we hope that nothing happens and everybody talks about well, it's just insurance. You got to have it and stuff like that. And you hope you don't have to need it or use it rather. But I find that model, again, yes, it's more upfront. Yes, it's more like, a little bit of a hit on the cash flow side, but when you have the ability to potentially recoup some of that or let it compound in the future, then it doesn't feel like you've just taken a bunch of money and lit it on fire because, nothing happened.
Well, it's life insurance being used during lifetime,
Right.
as opposed to what typically is the case where, look, at the end of the day, nobody's excited about purchasing life insurance.
Right.
It's one of those necessary evils, if you want to call it that. And
Mm-hmm.
us as guys are probably the most guilty of this, right? I mean, think of it, CJ. Could you ever imagine a situation where you're not there taking care of your wife and kids? There's
No.
never a situation that goes to your head. You're invincible, especially at this age. But what we know is we're not invincible,
Yeah.
right? At the end of the day. And if something does happen, at that point, you're powerless. So you'd rather be in a position of power to at least be able to dictate life on your terms. Now, there was one thing to switch gears a little bit because I think it's super important. And it's still shocking that, nobody knows about this is under the buy-sell topic. And you've heard me talk about this before.
Yeah.
It's a recent Supreme Court case ruling that still goes kind of unannounced throughout the industry, and that's the Connolly Supreme Court case. For those of you who don't read white papers in your spare time, here's essentially a Reader's Digest of what happened. Three brothers owned a company. They owned it as many do in a buy-sell arrangement with a family, a third, a third, a third.
Yep.
Company worth $30 million. Actually, first brother passed away in 2013, which shows you how wonderfully efficient our court systems are in just getting the case settled this year. However, what took place was the company owned the life insurance, as do most companies, on
Correct.
each of the brothers. And there's specific tax reasons why you would do such a thing. However, what took place is brother one passed away, and a third, a third, a third at 30 million, you would expect to pay his wife $10 million.
Yep.
IRS came back and said, no, no, no. Company's actually worth 30 million plus the $10 million of life insurance that they owned on brother one who died, which means the valuation of the company is 40 million now divided by 3, which was wonderful for the remaining spouse who got a few million extra dollars, and was absolutely crippling for the other two brothers who now had to come up with dollars out of cash flow, out of personal arrangements, and more importantly, out of the business, which was a drastic opportunity cost loss for them. So I oftentimes ask clients what we classify in the industry as a disturbing track. I'll say something as stupid as the following. I'm like, hey, CJ, you guys aren't having the business own all the life insurance on the key employees, are you? They say one of two things, Dan, or the CJ. They say, hey, Dan, I have no idea, actually. Why do you ask? We tell them this story.
Right.
Or they say, yeah, what do you mean? Of course the company owns it, which I would argue is more than half the time.
Right.
Really good value add solution. It doesn't even require buying any more additional coverage or altering many things. It's simply creating a master LLC that the company owns. And the master LLC's sole purpose is to own the life insurance. You keep the tax benefits, you solve this problem. And then, oh, by the way, we'd love to review the underlying coverages. What most people do with life insurance, which is very different, CJ, than most of the Higginbotham folks, which are renewing and actively attacking coverages on an annual basis.
Yep.
People buy life insurance, they stick it in a drawer and it stays there. And unless there's a problem or somebody like me gives you a compelling reason to review it, it stays there. And
Yep.
that's frankly scary. So for anybody listening that owns life insurance, we have a whole department that reviews this in and out. And it's a win-win every time for us, because either we come back to you and say, hey, frame this, put it on the wall. They don't make these anymore, right? You got the worst thing. It's like the worst thing that happens is a client's like, oh, good. That's cool. I have something good. Awesome. And these guys didn't try to sell me anything.
Yeah.
Best case that happens is either we're able to cut premiums, increase death benefits, or even do intangible things, right? CJ, like you've heard this story before. We had a guy a few months ago and I said, hey, who's Debbie? And he said, oh my God, it's my third ex-wife. Well, she is on your $30 million key man policy. That's the beneficiary of this. Could you imagine the problems that would have created for all parties involved?
Yes.
Again, simple fix, crossing out a beneficiary, one form, changing things. Very, very easy. But make sure your T's are crossed and your I's are dotted is really
How
consensus.
frequently do you recommend people review it? Like, I mean, do people need to review it annually? Is it maybe more life event related? Like, how often do you
Yeah.
think people need to be reviewing it?
Look, so some triggering life events, right? You have another kid, you take
Yeah.
on more, you get a bigger home, you buy another car, you have a large HELOC, whatever you're doing, right? It's usually a triggering event to say, all right, make sure I cover this gap. Depending on what policy you own, I mean, I would say it's probably a good idea to do this just like you guys do and review it annually.
Mhm.
With few exceptions, like a fully guaranteed policy, whereby you pay X, you get Y, it's guaranteed to Z years of age, and there's no moving parts. As long as you're paying the premium, there's not much to review there aside from, hey, can I get a better deal in the marketplace? Right?
Mhm.
Mortality tables have changed drastically post COVID. So that's good news for some, depending on the age, and bad news for others. Take a review, take a look at it, right? How many 50-year-olds bought 20-year term insurance that expires at age 70, whereby they look at that and say, damn, I wish I had another 10 years here, another 15 years here. I probably would have sucked if to pay for it, but I probably could have squeaked out a permanent policy to be able to have that either cash flow in the future or that, legacy piece to transfer out. So
So do you
I'll
think from like a timeline standpoint, again, I feel like there's different schools of thought. Like maybe the younger that you are, obviously the price is going to be likely more advantageous to try and do a whole life policy, or do you, when you're younger, kind of stick with the term because you know that things are likely going to, change as far as needs and things like that as you maybe get married, have kids, and, have these other life events that
Yeah,
happen?
so here's how I would think about this, and you won't have most life insurance people kind of run this in the same fashion. So, uh, life insurance always starts with the death benefit need. So, if you're a young, healthy guy, you just got married, you're making some good money, fine. Get a bunch of term insurance, right? 5, 10 million, stupid cheap, and use the remaining capital to do all of the following things: max out your HSA, max out your Roth IRA if you qualify, max out your 401k, max out investment options, start a brokerage account. It's at that point in time that you then begin looking at insurance as an alternative asset class,
Okay.
and only at that time. In my opinion, you'll have others that will tell you differently. They probably sell insurance for a living. But you look at so look, you look back, I look back on all the $50 and $200 a month policies I sold in a prior life at Northwestern Mutual. And not to say that that policy isn't incredibly good and has done its purpose as
Sure.
intended, but you've got Nvidia up 1,200% over the last 18 months. I think people should probably at our age be looking at investing. So that falls under, you had mentioned Dave Ramsey earlier, buy term, invest the difference. I think for a vast majority of your average Joe folks, I think that makes sense. Now, once you start talking big dollars, affluent clients, let's define that as north of 25 million, because that's
Hmm.
roughly where our federal exemptions lie. You'd be a fool, in my opinion, not to look at life insurance as a solution,
Right.
because just like any other thing in life, it works incredibly well for what it's purposed to do, which is provide a ton of leverage, income and estate tax free when you need it the most. So little bit of I guess dovetail into that world, CJ. For
Yeah.
those of you who are unfamiliar with how estate taxes work. So, very different from federal income tax and state taxes, which vary state to state.
Right.
You have an estate tax, also known as a death tax or an inheritance tax. And that works whereby the second person of generation one passes away. Typically, dad goes first, mom goes next.
Right.
Upon mom passing and money passing from generation one to generation two, you get whacked with another 40% tax. And the government's super, super nice, CJ.
Of
They
course.
give us 9 months to come up with the money, which for most people is a fire sale of all the things you would hoped to never sell.
Right.
Personally, businesses, vacation homes, real estate, income producing assets. Um, So, very simply put, we have an exemption in this country due to President Trump's tax cuts back from 2017, which we anticipate will be renewed upcoming shortly. We have the largest federal exemption that we've ever seen in history. And for a
Mm-hmm.
married couple, right now, it's just shy of approximately $28 million, which means if I am a $30 million client, I get to exempt $28 million, and the remaining is what we call a taxable estate that is
Okay.
due at 40%. So in that example, $2 million at 40%, we can all do the math here. You'd owe $800,000 and you'd owe that within 9 months. Now, let's make the numbers bigger, right? You're a $100 million client. Whoa, that's a big problem. Now we've got roughly $70 million of a taxable estate and we owe 40%. That's $28 million here. It's a big, big problem.
Yeah.
So for 20
So
years of
what
my
happens like if somebody like can't come up with that, like, worst case scenario or something, like what happens to that? Is it gone, poof, like?
gone, and a very famous example, as many may know, is the artist formerly known as Prince.
Okay.
He died what they call intestate, which means with no will, no life insurance, died naked. $200 million estate. Do you know how long it took the government to spend those proceeds?
30 minutes.
97 seconds. It's the reality of the matter. So those assets would be liquidated, tax would be paid, and they don't care wherever the market prices are at that point. I mean, could you imagine if you were heavy-handed in real estate and you died in '08? You're going to sell everything at pennies on the dollar.
Yeah.
Big problem. So for 20 years, we've positioned the following, and there's nothing wrong with this. It's, hey, if you owe $30 million of estate taxes, do you want to pay $30 million out of your pocket, or do you want to give an insurance company, let's call it $8 million, to guarantee $30 million when you die? That's just cents
Yeah.
and dollars and cents, right? That's just
That's money.
math.
Yeah.
That's math. So oftentimes life insurance gets viewed through what's called a lens of an asset class. And the way we do that is what's called an internal rate of return. For those of you who are like, what the hell does that mean? Essentially, what we do is we look at how much premium is going in, i.e., a contribution to an investment,
Yep.
how much money is coming at, which requires a little bit of us looking in our crystal balls and saying, well, when are we going to die?
Yeah.
So we oftentimes will look at ages 88, 90, 95 and look at, based on what I've put in over that course of time, because there's a time value of money component, what was my internal rate of return? And oftentimes you'll find life insurance to be 10, 12, 15% internal rate of return at life expectancy, which when you account for taxes and fees and income and estate taxes, that's north of getting a 20% rate of return in your brokerage account every single year. I don't know many advisors, and I tell clients this. I'm like, look, if your advisor is going to tell you that and sign a contract that says I can guarantee you I can beat this rate of return, let me know he's got my account too. But oftentimes insurance just becomes a natural way to
Right.
leverage and unburden that. And we actually have taken that a little bit further here inside of our organization, whereby we've found kind of the following two major events that have caused us to rethink how we essentially look to acquire life insurance for ultra high net worth clients. We found that when we get brought into a very high level sophisticated client, they've already used their lifetime exemption. And
Yep.
oh, by the way, that was a rounding error, guys. Oh, it's the highest in history. I didn't even notice. Um, and I may or may not like life insurance, but how am I supposed to buy life insurance? Because life insurance for estate tax purposes is held outside of your estate. And I can't move any more money outside of my estate. I've already used all of my lifetime exemptions.
Right.
So what do I do? Well, we can get a bank to actually fund the money on your behalf. A lot of intricacies to this. We won't cover too much of the details here today just due to
Sure.
time, but effectively, we can use a client's balance sheet, should they qualify, to purchase insurance as minimally as 10 million, as maximally as 300 million, with little to nothing out of pocket. Now, I know that probably sounds way too good to be true.
Got to be too good to be true. It's exactly right, right?
Way too good to be true. What's the catch? Well, the catch is at any point in time, should the loan be higher than the cash inside of the life insurance policy that we're buying for you, you need to post collateral for the difference. But for clients that have a ton of collateral, whether that be real estate, personally held businesses, securities, a combination thereof, this puts them in a position where they can save the hundreds, if not millions of dollars that they otherwise would have spent on life insurance to redirect towards their entrepreneurial ventures, which is really the main reason we get brought in. And I'll pick on the real estate guy because I chased him for years, right? And here's the story. Mr. $100 million real estate guy. You are literally the government's best friend. You pay 35% federal. Let's pick on California, 13% state tax plus 40% when you die, right? You are keeping less than 40 cents on every dollar you earn. We need to create something outside of your state. We need you to buy life insurance.
Yeah.
And he looks at this like we just talked about. What's the internal rate of return, guys? 12%. What? Oh, it's income and estate tax free. That's cute, Dan and CJ, but I get 30%, 50%, 90% rates of return on my personally held business, on my real estate, on my hedge funds or private equity. I'm just going to go solve this problem like I solve every other problem in life, and I'm just going to go make more money, to which we know is foolish.
Yep.
However, the opportunity cost for them to do their serial entrepreneur ventures is just so high that life insurance just becomes a very unattractive asset class for them.
Sure.
Well, what if they could use the leverage they've already had via their balance sheet to purchase the insurance they know they already need to make them not the government's best friend and not interrupt cash flow? That's where these, what they call premium financed strategies for life insurance, become super, super effective. Client gets to have his cake, eat it too, and effectively just use his balance sheet to acquire the insurance. I had a real estate guy recently tell me, he goes, I get it. You're mortgaging my life insurance. And the terms are nothing down and no monthly mortgage payment. And you're going to let the S&P build my home, so to speak. I said, that's very oversimplified if compliance is listening. However, the general concept is fairly accurate, and clients can decide if they want to pay interest, if they want to accrue interest. They've got a different, they can pay some premium too, but it gives them optionality and flexibility, which is the name of the game when we're talking high dollar clients.
Yeah. No, I mean, it's just fascinating what you have the ability to do. I mean, it's not, I think a lot of us just go to the simple basics, but it's like, no, there's things that you can use to work for you and not just be, it's not just cost, right? Like it's like it's something that's bringing value, not just something that's being, taken out of your account on a monthly, quarterly, semi-annual or annual basis. Like it's something that's continuing to build for you.
Yeah, and I would say at the heart of Higginbotham here and the work that we do for this firm is we're problem solvers. So we like to take the approach, hey, we educate, you decide. Leverage is not for everybody. Insurance is certainly not for everybody. It has some really, really nice applications when you dig deep and look at it. But at the end of the day, I used to do fee-based planning work at Goldman, whereby the high net worth client would dump his huge binders of stuff, for lack of a better word, on our table and say, is this good? I haven't looked at it in 5 years. We used to engage those clients. They'd pay us, I don't know, $50,000, and we'd go to work for them. And we now have the ability to offer that to Higginbotham clients on a complimentary basis, which is, again, very similar to a policy review, except a whole lot deeper. So for those clients watching, we'd love the opportunity to just double check what you're doing. Oftentimes when we've got our arms around 90% of your insurance solutions, this is something that it can really move the needle here for better or for worse, right? Again, worst case scenario, we tell you keep what you got, and it's a really great thing. For those at Higginbotham that are working with these clients that may be thinking, goodness, this is a lot of information. I don't want to get over my skis. Well, don't. Just make an introduction, allow us to do all the work for you. I mean, CJ, you and I have had some meetings together here.
Yeah.
It's pretty much throw the ball in our court and we run with it here and make you guys look good in the process. So I guess all that to say, like, we try to solve problems. If there's no problems to solve, we're not positioning insurance for insurance sake. I mean,
Yeah.
God, there's those people.
Well, and I think that's what I appreciate about you, and it's kind of the approach that I want to take. Like, I don't want to be just a salesperson who's just trying to sling stuff. Like, I want to be a consultant. If you are in a good position, perfect. That is great. Stay in that good position. Like, I'm not just going to sell you something for the sake of doing it. I want to create value. And, I always tell groups that I work with, like, it's my job to present options. I can't force you to do anything, but like, hey, here's what we found. Here's what we've discovered. Does this make sense to you? Do you want to do it? If you do, great. If you don't, hey, that's fine. Like, I'm just telling you what we've seen, what we've uncovered, what we recommend. But ultimately, at the end of the day, it's your decision. We're not going to force it on you. And just in a lot of our experiences, I mean, that's what you've done with groups that we've gotten in touch with and discussed. It's, hey, y'all are good. Stay where you are.
I'll give you an example of how this pivoted, because it's also kind of a unique discussion that I don't know that we've covered here on the call. It actually hits pretty close to your world, CJ, which is executive benefits. So we
got to cover that. So yes, I'm glad you're getting into it.
We got in front of a major law firm. I'll leave the name out of it. One of the big ones, you'd certainly recognize the name. And we got brought in to show off some of our, fancy widgets, if you will. Some of our premium finance toys, some of our private placement life insurance operations. And what we found there was those guys were in pretty good shape. They do this for a living. Yeah. So they knew what they were doing. They were open to the review based on the relationship. And we came back to them and said, hey, this looks pretty good. You may want to tweak some things in the language of this trust, and you may want to cross a T here or there, but I wouldn't change anything. The life insurance is very competitive. Unless you guys want to add leverage to this, I would keep where you're at. And they said, okay, that's great. I said, do you mind if I ask a couple more questions? Yep. So, I saw this thing on your balance sheet here. It looks like you have a pension from the law firm itself. Yeah. Is that available for everybody there? I'd like to come work for you. No, I'm joking. Is that available for everybody there? He said, no, it's just for the managing equity partners. So there's about 2,900 or so people in the firm, and there's about, call it 600 managing equity partners.
Yeah.
So I said, oh, that's really cool. Can you tell me more about that? Yep. We've got cash balance plans. We've got profit sharing plans. They've got all the goodies. Perfect. Just making sure you had everything there. I said, what are you guys doing to retain your top executives currently? And he said, that's really interesting, Dan. We just had a board meeting with the 600 managing equity partners. And do you know who the most valuable people are in the company? The 600 managing equity partners. And he said, we decided unanimously that we should take care of each other.
Yeah.
I said, good. How are you planning to do that? Well, we're just thinking of like some deferred comp options for the company. I said, well, that can become very complex very quickly. There's ERISA rules that state, hey, CJ, if you and I own a company and we want to stick a bunch of money away on our behalves, we need to put a pro rata portion away for the other employees, which, depending on how large the company is, in this case, that's another 2,000 plus employees we got to take care of. Ooh, that ruins things.
Yeah.
Well, life insurance has this unique feature that allows us to walk around these ERISA rules and do so in what's known as a discriminatory basis, meaning I can hand select the partners from this plan. So we're helping them walk through a solution whereby we put life insurance in place for the 600 managing partners. Some will be financed, some will be non-financed. And simultaneously, the firm is going to put in a vesting schedule, effectively what we call a golden handcuff plan.
Yeah.
Whereby it would say, hey, CJ, you're one of the managing equity partners. We cannot afford to lose CJ down in Alabama. He's holding it down there. We're gonna gift you a life insurance policy. Now, there's strings attached. If you leave in the first 3 years, you get nothing.
Yep.
You stay with us for 5 years or more, you get half. You stay with us for the next decade, you get the whole thing. And so for each of these managing partners, that may mean $100,000, $200,000, $300,000 of tax-free income into their retirement. We've executed this in the past with larger organizations like this, and what we have found, no one leaves.
Yeah, I mean,
So,
because those are big numbers we're talking about, right? And as we discussed, like even in that buy sell, it's not just a death benefit. Like it's not just available to them. And correct me if I'm wrong. I'm making sure I get this right. But it's not just one of those things where their family benefits if something happens. It's something
no,
where, hey, they're done. They're retiring or something along those lines. And there's
yeah.
value that's still being added, not
How
just
about
a death benefit.
how about the value to the corporation? Not only the employee retention, but guess what, CJ? Out of 600 people, a couple people are going to die. And when that happens, depending on where they are in the vesting schedule, in order to get a couple $100,000 a year to each partner, I got to buy a couple $1 million worth of death benefit. So let's say I'm 5 years in and I was supposed to get 200 grand a year for 10 years. That's $2 million. And the death benefit's five. Well, 5 - 2 is what the corporation keeps.
Yeah.
They now add that to their slush fund overhead, do whatever they want to, cash flow expenditures. That's a really big deal. It's self-completing.
Yeah.
So again, a nice way to add value. It wasn't in the manner that we had hoped to add
Sure.
initially, but in having a deeper dive questions around clients and just trying to figure out, hey, what keeps you up at night, right? What problems are you facing? I can't solve all of them, right? I need to make more money. I can't help you with that. Join the club, right? But these are dialogues that we're accustomed to having, and these conversations are vastly different, CJ, than the conversations that you're specializing in. I don't know anything about employee benefits, and I know how to tee up the conversation, CJ,
Right.
right? In terms of where it's appropriate and how to get people in the mix. I think that's probably in our Higginbotham partnership,
Yeah.
the thing that we're doing the most.
Yeah. And I think that like that model is just, again, because you were the one that kind of introduced me to some of those things. Because, when I would think about, and this is just me, low level guy, when I would think about this stuff and people would say, oh, we want to, protect some of our key employees and stuff like, your mind just initially goes to, oh, well, we can do like a traditional key man or something like that. But like the more that I started to think about it before you and I talked, I'm like, well, I mean, that's great and all, like giving them, hey, here's $1 million life insurance policy that we want to protect you in the event that something happens. But like, it's nice to have, don't get me wrong. And like their family would be grateful in the event that something happened. But I feel like a lot of these employees are like, I need something that's like more valuable to me. Like if I stay alive, like, it's one of the, like, I want to be a little bit more taken care of and my family more taken care of than just a death benefit to them. Again, like that's important. Like hear me when I say that. But again, like the opportunity to have something that will continue to pay or continue to provide value while you're still living that brings value to, both the person and their family, I think is just a huge win, again, like you said, both for the company, but also for these key employees. Like that's really a way to feel taken care of and important is we're going to invest in you, not just protect your family in the event that something happens. I feel
I
like
mean, so Higginbotham does the same thing, right?
right.
You look at their stock ownership program, founded by an ESOP, big dividend because it's privately held. Who leaves here, CJ? Nobody leaves
Yeah.
here. And there's many more reasons why that's the case aside from economics, but the economics don't hurt.
Right.
And that's the same essential value proposition that we're discussing.
All right. So give me your kind of let's go back and then also look forward. Like how has this industry changed, maybe within the past 5 to 10 years that you've been in it? And then, what does it look like maybe in the next 5 to 10 years? This is like, I could be way wrong on this, but like, does AI have an impact on any of this kind of stuff? I feel like it touches everything. So how has it changed in the past 10 years? And what are you kind of thinking in the next 10 years as far as what this space, what this industry looks like?
Yeah, it's changed a ton, and it will continue to change a ton, I imagine, over the next 5 to 10. You're definitely right about AI. You saw the industry take a huge turn during COVID, right?
Right.
Most life insurance carriers were projecting 10-year treasuries no less than, call it 1.75, 1.85, somewhere around there. And we all know what took place there, drastically below that. So the story is as follows. A lot of the giants fell the hardest. right? Because they had the largest books of business, the largest blocks of exposure. You saw life insurance carriers take multiple billion-dollar write-downs. The beauty of the life insurance industry, though, is the fact that no claim has ever gone unpaid, right? So if there's ever a insolvent carrier, they get purchased out by the larger guys, and the integrity and the fabric of life insurance gets maintained. You've seen a shift in products, right? For 10 years, we sold nothing but guaranteed products. Then we had guaranteed variable products that also had cash. Then as interest rates tanked, carriers did not want to sell these guaranteed products because as interest rates tanked, regulators started looking at the financials of insurance carriers and actually raised reserves. So now they're getting less yield and they have to stick more money away to reserve for policies. That's a big problem.
Yeah.
So unlike Higginbotham, which continues to expand, a lot of life insurance carriers, so life insurance distributors, large RIAs, and even wirehouse carriers have cut back on resources because of that, which is a huge detriment to their clients. If you're a $1 billion client, I won't mention the firm, but it's a very prominent one, and we discussed it here earlier. If you call them in and want to ask about life insurance, they're going to farm you out to a third party who knows absolutely nothing about the company, knows nothing about you, and is probably going to try to jam a square peg in a round hole, to be frank. You will continue to see, in my opinion, exiting from large wirehouse institutions into the independent space. It seems to be where all the smarter and more creative folks are headed. Mm-hmm. You will continue to see advancements in tech platforms, as well as AI. So there's goods and bads with AI. We had the chance to do a deep dive at Pacific Life's home office last week in Newport Beach. We got to speak with one of their head Dawn Trotman there, and she kind of walked through. I had asked her, where is AI in the relation to this? And she said, look, we're using it in all the ways you would think in terms of expediting medical records and double checking processes and making sure everything's just real tight from a compliance standard, process, procedure, expectations, so on and so forth. Where we're flirting with it, Dan, but we're not there yet, is on the underwriting side. Right. So you could literally download an underwriting SOP manual into ChatGPT and say, here's a client's medical record. What would you rate them? It's going to be pretty close.
Yeah.
Unfortunately, life insurance underwriting is equal parts science as it is art form. So they're having people massage it after the fact. And, you couple that with HIPAA and compliance issues, and it's not there yet. It'll get there.
Yeah.
In my opinion, it'll get there. And that will add to the efficiency of the industry itself. I mean, the life insurance industry is still relatively archaic, right? If you've gotten a life insurance application, it's still, we're still killing 100 trees to get it to you. And now we're into the DocuSign age. Whoa, slow down.
Look out.
Which was huge for us. But nonetheless, you'll continue to see advancements in that, just like you're seeing in, the asset gathering and management space, where you've got artificial intelligence robots now doing day trading on your behalf. I mean, they're performing well. I think there's still value to having a human interact there. I don't know that we'll ever lose that component in this industry. Just given all the complexities, right? Second marriages, I got a kid who's a knucklehead. I want to take care of this, that, and the other thing. That's not something that ChatGPT is at least able to account for now, or AI in general, I should say. But I think you will continue to see new product innovation, right? Annuities are getting creative. You're seeing some private placement life insurance, which is vastly different than retail. Banks and insurance carriers are now, getting linked up to figure out how do we join teams here and provide value for our clients. So I think you'll continue to see, frankly, a whole bunch more of that.
Okay. And then there's one thing that I want to make sure we cover, because I feel like it's, with the generational, shift that's kind of happening and stuff, this will be the last thing, but long-term care, like, I feel like it is, in my opinion, such an under-discussed and utilized form of insurance. You might have a different opinion. You are the expert, so I'll defer to you, but I do kind of want to touch on this because it seems like, numbers that I've seen is that, married couples over 65, the likelihood of a long-term care event happening is like something north of 75%, but maybe
It
less
is.
than 10% of people have long-term care
Yeah,
insurance.
you're spot on with those stats, and I'll take it a step further. The average claim on an annual basis, and Alabama is going to be vastly different than California,
Sure.
but average claims about $112,000 per year. And the average duration for males is about 3.5 years, and the average
Yeah.
duration for females is slightly longer at about 4.5 years. So when you look on that, that's about 8 years of roughly $100,000 of exposure. That's an $800,000 ticking time bomb coming to your portfolio at a 70% likelihood. That's terrifying.
Yes.
Um,
Both
that's
for the children, like, as well. I mean, my parents are 70 and they thankfully both have long-term care. Like, one was provided to my mom through her company, and then my dad got one in place. So it's not just terrifying for the parents who might be the ones that have this claim, but also for the children who end up potentially either being financially responsible or physically or any of those things. Like, it's a terrifying.
there's a couple of things there. You look back 20 years ago, and the Forbes most hot topic on people's mind was outliving their money. People were living much longer than they anticipated, and they're running out of money. You look back a few years ago, and it was long-term care. Oh crap, we solved the money. Now we're living much longer. Doctors are keeping our bodies alive longer. Most of the long-term care claims, CJ, they're cognitive. Alzheimer's, dementia,
Mhm.
all those things related. That's where it comes to. In the worst case scenario, I think the worst nightmare for a lot of people is, I have to burden my kids and then physically rely upon them to do things that I won't even mention on this call,
Right.
right? That's a terrible situation to be in. Now, you saw long-term care come on like gangbusters, very similar to term insurance. You pay X, you get Y, except it wasn't guaranteed, and Y kept going either down every year or X went up. These long-term care carriers wildly mispriced these products. They also mispriced how many times clients were likely to actually use these things, and most of them have since exited the space entirely. Now, good news is product innovation allows for, hey, you want to go to a nursing care facility. There used to be a bunch of what they call donut holes or missing gaps in coverage for long-term care policies. Nowadays, most of the products will provide for full soup to nuts coverage, whether that be at a facility or in home.
Yep.
And some companies, even like Nationwide, will offer what's called an indemnity benefit, whereby they simply send you the check each month should you qualify for long-term care. You can use it on whatever you'd like,
Right.
including paying your kids if you so desire. Sometimes that's a huge win. Sometimes it puts the children in a position of supervision instead of care.
Right.
That's really the end goal. And I don't think that most people need to go out and shield themselves for $800,000 worth of long-term care, right?
Right.
We don't need to plan for the Ritz, but plan for at least half of it, three-quarters of it. Remove the
Subsidize.
vast majority of a sting out of it. And unlike term insurance, or what was known as traditional long-term care insurance, where if you stop paying for it, you lose it, a lot of the products nowadays are what's known as hybrid products.
Yep.
So not everybody that buys long-term care is going to need long-term care, but everybody's going to pass away at some point. So
Right.
these hybrid products couple life insurance with long-term care. And depending on what your primary goal is, if it's life insurance, we do a life policy with long-term care. If it's long-term care, we do a long-term care policy with a life insurance attachment to it. So it gives you those flexibility and options
Right.
to make sure you're not just spending money or renting coverage that you may never need. It
Yeah.
also prevents huge premium spikes. These premiums are guaranteed, they're level. And just like all life insurance, it's going to give you some leverage. So if you put 200 grand in, now maybe you got $400,000 or $500,000 worth of long-term care benefits. You've tackled and solved this problem on your terms instead of on life's terms in the
Yep.
future.
Do you have
So
an age that you typically recommend people start looking at, maybe those hybrid options, or just some form of long-term care in general? I'm not going to steer them to a
yeah,
specific product or anything.
unfortunately, most of the company, not most, but a lot of times we get brought in for clients that it's already too late.
Right.
Hey, I'm
That's
starting
what
to
I want to avoid.
cognitive. It's the same thing as like you got into a car accident and you're trying to buy auto insurance. Unfortunately, the reality of the situation is, I think 40 is probably a good time to start looking at it.
Yeah.
Whether or not it's in your wheelhouse to afford is a whole different whole different animal.
Of course.
But I would say at a bare minimum by age 50, if you haven't at least begun planning for something, and I don't care what it is, stick money underneath your mattress if you'd like to. But the reality is the threat is real. And you're talking to somebody who watched it firsthand. I mean, my grandfather had Alzheimer's. My grandfather was an incredibly successful guy, hated life insurance. The cliche, what are you doing life insurance? That's stupid. We don't buy that stuff, right? Yeah, $4 million of care later, we probably should have had long-term care insurance. And then you take that a step further and you think of the emotional damage that takes place there. My mom's one of five sisters, excuse me. You could cut the tension at Christmas dinner, right? And this was pre-estate, the settling. What tends to always take place, the oldest and the closest in proximity is who takes care of the parents. And those people get hung out to dry. There's a documentary on HBO. It's a husband whose wife had an event, needed care. They interviewed him annually. It's heartbreaking. I'm getting chills thinking about it. But the first year, he's like, "This is a privilege. This is an honor. My wife took care of me my whole life. I'm going to take care of her. This is my duty, right? I'm gonna own this." By year 2, he's like, "This is the worst. This is the worst thing I've ever done in my life. Like, my wife doesn't recognize me. She doesn't know who I am. Yeah. Like, I'm cleaning diapers. I'm doing all these things. Like, I have no life. I'm just like literally living to take care of her, who she doesn't even know me anymore." And it's like, it's heartbreaking. But not to say that long-term care would have made that substantially better, but at least he's in a position where he can at least live his life still, knowing that his loved one is being taken care for, and they're interacting in a manner of not doing the heavy lifting, right? So that's what long-term care is there for. It is way more than catastrophe insurance, right? Again, your chances of predeceasing are far outweighed by being disabled at some point in life. Yeah. So I hate to end on a morbid topic.
No, I mean, but it's important, right? I mean, it's just one of those things that, like I said, I feel like is under discussed, especially right now with, the boomer generation and everything like that. Like it's just a critical piece that I feel like is just underutilized by people.
Yeah. And us as guys, we're the most guilty, right? I can't tell you. I had a guy down in Texas not too long ago. He's like, "Buddy, long-term care, that's what my 45's for." I said to him, okay. I said, "Oh my God. Well, that's a bit morbid." I said, "Let me ask you a real question though, sir." He goes, "What's that?" I said, "Happens if you get Alzheimer's, dementia, and you forget where you put it." He goes, "Oh shit, honey, come down here. This guy's good."
Time for a conversation.
I said, the reality of it is first off, you're not going to shoot yourself, right? I mean, let's be serious. And secondly, I said, most of these claims are cognitively related, right? Yeah. Doctors got pills for everything. They can't fix our brains from turning into mush past 90 years of age. That's just the reality of it. So, just explore the concept, have somebody price it out for you, take a look at these hybrid structures. Some of them have even return of premium options, so you can get your money back if you decide, hey, I can no longer afford this. But in the same breath, don't bite off more than you can chew, because it is insurance at the end of the day.
Yeah. Well, Dan, this was incredibly insightful. I mean, just on so many levels, from the 101s of term life insurance all the way to the, premium financing that frankly goes above my capacity for understanding. But I really appreciate your time and just grateful that you took some time on this Friday.
I appreciate you having me. Happy to hop on here anytime, and have a wonderful weekend.
All right, bud. You the man. Have a great day.
You too, pal. Take care. Bye.